we are extremely delighted to have with us a key member of the Center for Global Finance Network, Professor Issouf Soumaré from Laval University, Canada, who has brought to us a very, very interesting paper, and also with the co-authors, Dr. Désiré Kanga from the IMF, and Kanga was, of course, with the Center for Global Finance just only a couple of years back. And Professor Hubert Tchakoute-Tchuigoua from Kedge Business School, France, who is indeed a distinguished researcher. And we're glad to have you on board today. The topic is absolutely interesting. Trying to shed some new insight into financial sector development, but focusing basically on MSMEs and bringing in the social mission of some of the companies, especially the small companies, the emerging companies. So it's of mentioned to me that it's work in progress. So I would like to call upon colleagues to be generous with the comments, suggestions, criticisms, and so forth as usual, given the usual cut and thrust of the Center for Global Finance seminars. I know that almost everybody here has met and knows Issouf. But then it's always great pleasure to introduce Issouf, just in case you haven't come across Issouf. Professor Issouf Soumaré is a full professor of finance and director of the Laboratory for Financial Engineering at Laval University in Canada. And from 2012 to 2020, he was the director of international relations. This is the international relations part of the Faculty of Business Administration at the University of Laval. And also previously he's worked as director of the PhD and MSc programs. And previously he worked for the African Development Bank as a risk manager in the risk management unit 96 and 98. Also, maybe I should highlight a little bit more about the work he does. Recently, he's grabbed our global attention by being the president founder of Soumaré University in Abidjan, Côte d'Ivoire, to which I have committed that I will support that university the best of my ability in any form necessary. But he's also the co-president of the Pan-African Institute for Economic and Financial Governance and vice president for the program of the African Business and Entrepreneurship Research Society, the ABAS, to which he has invited quite a number of the people here, including myself. And also president of the Scientific Council of NCEA, the Center of Research Excellence, funded by the World Bank in West Africa. And of course, for a number of people here who work with the African Economic Research Consortium, you know that he is a distinguished resource person for the African Economic Research Consortium, ERC, which is headquartered, which is Pan-African, but headquartered in Nairobi. And I could keep on mentioning the many collaborations he had. He was a co-investigator on a large project that we hosted here at SOAS University of London on financial inclusion and again leading on one of the mainstream areas, and also of course leading on so many other research projects, especially the work with the Central Bank of West Africa. And his work has focused now recently on financial engineering, especially the great work on catastrophe bonds, international finance, development finance, risk management, and development banking, and all of them with a huge quantitative finance flair. And he keeps on providing vital services and capacity building seminars to many organizations, including the one that he's doing next week in Dar es Salaam. Issouf, it's therefore great pleasure to welcome you here to present the seminar this week. Please go ahead.
Okay, Victor, thank you very much. Thank you very much for this very, very generous, introductions. And then also thanks a lot for giving me the opportunity actually to present our work here. It's always a pleasure actually to come to present to the Center for Global Finance actually. And I can see old friends. Actually, it's always a good occasion actually to be able to connect with old friends and also all these, really high-profile scholars actually. Thank you very much actually. And as Victor said, the paper I will be presenting, actually, this is really new. We are even, in starting with writing of the paper. It means that all ideas are very welcome. And also we really need ideas, actually. If we even have to tear down the paper and then start it again from scratch, that will be really wonderful for us because we need idea as we go along in writing this paper, actually. What I will be presenting is basically the role the financial sector development will play in the financing of SMEs, micro, small, and medium-sized enterprises, especially the financing coming from the microfinance institutions. This is basically what we'll be doing. Then the idea is basically, do actually microfinance institutions provide more funding to small firms when the financial sector is more developed or not, right? That's really basically what we really want to explore. And why, I do want to explore this topic, but just before getting to my next slide, I would like to say that this paper is a joint paper with Désiré Kanga, who used to be at the Center for Global Finance. He used to be a research fellow there, actually, basically, in London. And also with, is now at the International Monetary Fund in Washington. And also with Hubert Tchakoute-Tchuigoua, who is at Kedge Business School. I think Hubert is actually connected right now. If you have any question which are much harder, then probably I will pass on. Hubert is much more knowledgeable in microfinance than myself. Then, okay. But I'm really glad he's with us here. At least he can take on the hard question, actually. Okay, basically, why are we studying this one? First of all, let me start by saying that we all know that, and then this is not new. We all know that small and medium enterprises play really an important role in economic growth, worldwide, and this is known. They account for most job creation in the economy, and then these have been stressed by many, many authors. You have some of them are listed here, Adelino Robinson, Ayagari and co-authors, Irispoli and co-authors also, and Dikok and co-authors, and Congolo as well. And also recently, I just took that from the World Bank website, on SME finance. Basically, they kind of confirm the fact that SMEs account for the majority of businesses worldwide, and they are very important contributors to job creation and job creation in the economy, and also for global economic development. Basically, if you look at the numbers, looks like 90% of businesses worldwide are SMEs, small enterprises, and also 50%, at least 50% of employment of jobs really in the economy are being created by SMEs, actually. And then even further, if you look at the SMEs contribute up to 40% of national income, at least actually, these are really formal SMEs, because we do know that if you take our developing countries or even, emerging economies, we have a lot of informal companies, and most of these informal enterprises are small enterprises. And then these 40% are very conservative numbers. And also 7 out of 10 jobs at least are being created by SMEs, actually. That shows really the importance of SMEs in the economy, especially in the economy, developing economies and also emerging economies. So having said that, we also know that actually SMEs, they kind of struggle to finance their growth activities. I mean, there are a lot of evidences on that actually, and some of them are listed here, Goff and co-authors, Ula or Alton and co-authors as well, and then many other people. I just list a few of them here. And of course, we know the importance of SMEs in the economy, but we also know that they don't have easy access to financing from the traditional financial sector, especially from the banking sector or from the stock market, for example. It's really hard for SME to get the funding from those, established, financial institution or financial markets, actually. And then I did, a work for the International Labour Organization, even this year, early this year, this on SMEs and guarantees also. This really was some of the things that really I come across in the literature as well, and also other papers. There was a work on by UNICA also in 2020 on really the financing, corporate financing in general, actually, and then this was also highlight actually in what they come up. And also there was a work by Foy, by Raji and Beck and Cole, and also among many other authors actually that actually stress the same kind of argument, the same kind of constraint, financing constraint of SMEs. At the same time, we do know that actually financial system in many emerging economies, actually many emerging countries are underdeveloped. Then all this basically put a lot of constraint, for household and for medium and micro, small and medium-sized enterprises to get access to financing, to financing. Having said that, right, then I talk about, really the fact that, basically the small enterprises it's hard for them to get financing from traditional banking sector, actually, and the traditional financial market. But at the same time, we do know that actually we have some other type of financial institution, the microfinance institution, which are basically they are supposed with a mission, actually, what we call basically the double line mission. They are supposed actually to get into the lower end of really the lower end of the clientele, actually, to small enterprises, to the poor households, and so on. And this is basically the mission of the microfinance institutions. And we know that in many emerging countries, actually, those microfinance institutions are playing a key role, actually, in terms of really providing funds to bottom level, clients who are not able, actually, basically, to access, the traditional financing coming from the banking sector, for example. Of course, the microfinance institutions, we do know that they combine these double missions. Actually, they have to make profit or profit-oriented ones, and also at the same time, also they have to be sure that they provide funding to really people who are excluded from the traditional financial sector, actually. So, having said that, then we can kind of wonder whether actually if we have in a country where the banking sector is very large, where you have a really deep banking sector or a very well developed financial sector, well, what will be, be really the behavior of MFIs in terms of really extending loans to micro, small, and medium-sized enterprises, right? We may think that, if this answer should be straightforward. That's not true, actually, because we can think of really, if the financial sector is well developed, then we can think of maybe, the small enterprises can get more money from the financial sector, then they don't need too much, the microfinance institution necessarily. But at the other end, basically, at the other end, and also the financial sector also can provide funding to the microfinance institution to be able to extend it actually to those small firms, actually. That can be one way to see it, actually. But at the same time, also, I mean, if we have a well-developed financial sector, maybe there is a more competition in the sector and so on, so on, then that can drive out somehow the microfinance institutions, and then maybe more lending can be coming from the traditional financial sector and not from the microfinance institution. And so then we can have a two, I mean, effects, I mean, somehow in the economy, and I will come back to that and so on. And which one dominates is not that clear really, how really the behavior for MFIs lending, I mean, to SMEs, what will be really, are they really extending more loans or are they extending less loans? I mean, when the financial sector is getting developed, this is not really clear, I mean, from the existing literature. And also, actually, there is also this idea of commercialization of the microfinance industry. Basically, this is the fact that the microfinance industry is more and more behaving like the traditional banking system. They are getting more funding from the financial markets. They are going to clients of the traditional banking system, then the wealthier clients, and also the big companies and so on. Then there's some evidence of that actually. Then if this is true actually, then how are the lending to SMEs being affected actually? Then the worry is basically that if they are behaving like banks, that maybe the SMEs, which are excluded from the formal financial sector, will be even more excluded actually. Then this is, I mean, something also we really want to explore to see really if this is what is happening actually. Basically, that's it. Then having said that, with this preamble, then what are we doing exactly in this paper actually, and what are our contributions? Okay, basically what we are doing is that we really want to investigate the relationship between countries' financial sector development and the loan extended to micro, small, and medium-sized enterprises by microfinance institutions located in those countries actually. Okay. And then to do that, what we'll be doing, basically, I just summarize, I mean, the key findings and so on. Then if for any reason some of you have to leave, I mean, before the end of my presentation or for anything, I mean, if you cannot follow some of the things I will be saying, but at least you know where we are heading actually. Then we use really an international sample of microfinance institutions worldwide, I mean, across, I mean, the globe. And that covers the period from 2001 to 2019, almost 2 decades, okay? And then using that sample, what we found actually basically is that we really found a strong positive relationship between financial sector development and MFIs lending to small enterprises actually. Then it looks like when the financial sector is getting more developed, almost like microfinance institutions are extending more loans to micro, small, and medium-sized enterprises. Okay, then in other words, that's basically what we are really finding here actually. And moreover, actually, something also we are finding is that basically, if you look at the banking sector expansion indicators of financial sector development, by, I mean, using really banking sector really expansion indicators, it looks like, and also the overall financial sector development actually indicator as well, if we look at those ones specifically, it almost look like the positive sign we find like this positive relationship between financial sector development and lending to small enterprises. It looks like this is real much more among regulated microfinance institutions, privately owned microfinance institutions, cooperative and credit unions type microfinance institutions, but not among NGOs, non-profit organizations, MFIs, not among, I mean, non-regulated MFIs. That's really interesting. I mean, it tells us really something about because, you know, microfinance institutions, I mean, they are very heterogeneous. Actually, they are not exactly the same. Some of them are profit-oriented, others are not profit-oriented, some of them are regulated, some are not regulated, and so on. Then, depending on the type and so on, looks like the behavior will be really different and so on. Then I will get into that. And probably, I mean, some of you on the public, you can also help us really in terms of some of the intuition, really we can, in a way forward actually in drafting our research paper basically. But basically, this is where we are right now. Of course, we have other things in terms of the channels and so on exploring, but really what I will be presenting to you today, these are really the main results. Sometimes some of the results we are finding right now. Of course, in the next step, we have to explore deeply actually the channels, and some of the channels we want to explore is really in terms of the liability side of the balance sheet of really the microfinance institutions. And then you'll understand why I'm saying that, because some of the channels we really put forth is basically this is coming from the channels of the way the microfinance institutions are getting the funding, actually. This is what we really want to explore in terms of channels, actually, how they are getting the money to be able to extend more loans, actually, to SMEs, actually. But I will get back to that, soon. Basically, this is really our contribution. Then let me summarize it really here. Is basically we found actually the positive relationship between financial sector development and loans given to small enterprises by microfinance institutions, actually. And then this seems to be really driving a lot by regulated MFIs and also privately owned MFIs and credit cooperative and credit unions type of MFIs, but not NGOs and not non-regulated MFIs, actually. This is what we are actually finding, actually. Okay, now let me go now in terms of the details of the paper's presentation, actually. Of course, in terms of the literature review, what are we adding into the current literature review, actually? Right? Well, we are combining actually several streams of the literature to address the financing needs of micro, small, and medium-sized enterprises, actually, right? Financing by MFIs and also combined with for financial sector development, actually. The first thing is basically there is all this literature of saying that basically the microfinance institutions tend to be affected by economic crisis, actually, or by the business cycles. But this is it can be intuitive or it can be counterintuitive, because what we are expecting from the microfinance institution is basically to get into the poor population, the rural area population. Then we can also expect them actually for the lending to be counter-cyclical. Why not? Actually, but this basically there is clear evidence that microfinance institutions, at least some of the microfinance institutions, lending are affected by crisis, actually. Then Wagner and Winkler at the paper in 2013, where they look at really the financial crisis of 2007, 2009, the global financial crisis. And then what they found basically is that the crisis has affected also the microfinance institution lending, in general, actually. Right? Especially,
excuse me, so
yes.
are you presenting the slides right now?
Yeah, I'm going through the slide. You are not seeing it?
Asina, can you see the slides?
Yeah, I can see the slides.
Okay.
Slide number 6. We can see slide number 6.
Okay.
Yes.
Okay.
Yeah.
Please go ahead. Sorry. Yeah.
Oh, okay. Are you okay? Okay. Yeah. Yeah, then basically there is this paper by Wagner and Winkler on the fact that during the financial crisis, looks like, microfinance institutions are also cutting on the lending, like the banking sector, the evidence from the banking sector, actually. And this also was something also in the case of Nicaragua in 2008 crisis in Nicaragua. There is a paper by Castellani and Alfonso who actually come up with the same type of conclusions. And of course, they found that, the MFI, which are kind of diversified geographically, somehow the effect is much more less for those type of microfinance. But overall, they find the same kind of conclusion like Wagner and Winkler. And in a paper, had we for Hubert Tchakoute, who is also one of the co-authors of this paper, and also with Issouf, a co-author of mine. We had a paper in 2020, which has been published. And then in that paper, we really find that the lending of microfinance institutions is kind of cyclical. It's kind of follow the business cycle, actually. But more especially for regulated MFIs, which are mostly privately owned microfinance institution. Those type of microfinance institutions follow the business cycle like banks actually. This is what we found, in that research, actually. Then this is the first trend of literature. Okay. The second trend of the literature is basically that MFIs are lending basically, and MFIs lending, actually, in the MFI lending, we can see competitions or the competition versus substitution argument, made actually. But the idea is basically when they are exposed to more competitions, sometimes MFIs will go much more to the poor segment of the, of the lenders, actually. Those lenders who are not actually reached by the banks because of the competition pushing them out of really the clientele of the banking sector, actually. There is also this type of literature existing, this type of literature also exists. Then some of the papers on that is by Cool and co-authors who find actually that a greater bank penetration than more competition from the banking sector actually in the overall economy will actually push the micro banks actually to poorer markets actually. It almost looks like that we are pushing really microfinance banks actually out of really the banking sector, clientele segment, and then to go really to look for really the poor client, the small enterprises, and so on. So then this is much more the idea of type of substitution somehow actually here. And also there is also this paper also Van Roos and Despalier, which actually found that MFIs will reach more clients and are more profitable in country where really access to the traditional financial system is low actually. Then when the traditional financial system is not accessible and when there is less financial inclusions, looks like really the social missions of the MFIs is more achieved actually. Right, that's all. So what they are finding actually, and then they go on making a lot of argument about that. But the main idea is basically that, and then basically it's almost like the competition is pushing real microfinance institution down to a market and makes mission drift by MFIs less likely. It means that really they are achieving much more of the social missions because of these competitions coming from the other part of the financial sector actually. This is another strand of literature which actually we touch on also actually now. Basically, in terms of conceptualization on what we really want to achieve, the way we see it is basically, then you see on my chart here, you have a micro, small, and medium-sized enterprises asset to financing. On the right-hand side here, you have the banks and financial sector development. And on the bottom down here, you have the MFIs and financing the channels, from the MSY financing. Well, basically, we have there are two channels, basically here. Okay, then the small enterprise, they can get the funding directly from the banks or from the financial sector directly, like from the financial market. Some of you will do know that some of the small enterprises can go straight to equity market to raise equity, to raise debt on the market directly, or they can get the funding from the banks. That can happen. But these are not the small enterprises we are much more concerned about, because those small enterprises are okay. But the type of small enterprises we are more concerned about are really much more those who are not able really to access those type of traditional financing. Then they rely on other type of financing, like the microfinance type of financing. Then with the financial sector development, what we are expecting is basically that the microfinance institutions are able to get the funding from either from the banks, or they can get the funding directly from the market. Okay, then direct funding from the market. And with those investments coming from the financial market, then they are able to extend more loans really to SMEs actually. This is basically the conceptual framework we had in mind actually in terms of what we really want to propose here. Basically, this one, to put that in words, maybe let me come back to this. Then we actually look at the direct lending channel. Okay, the direct lending channel, because MFIs are very heterogeneous in terms of institutional forms, in terms of business model, because some of them take deposit. There are other MFI who do not take deposit at all. There are some MFI which are regulated, like banks, and some MFI are not regulated at all, depending on the countries and so on. Then they are very heterogeneous in the forms. And then, given that real distinctive features of a sector, real in terms of heterogeneity, the type of mission they want to achieve, and they are very different from bank, well, then the lending also can be in part in a different way, actually. right? Lending can be in part either, by the domestic and international crisis, and then this have a paper I just talked about some of those papers before, like there are paper by Aline, there are paper by Wagner Winkle, and so on, and some of the paper we also did actually, where actually we kind of showed that with really business cycle, with a crisis and so on, then direct lending will be affected actually. Okay. And also, there is also this evidence of that microfinance institutions in general do not follow necessarily the same risk management practice like banks, because they don't have really the same type of financial capability, the same type of human capability to do it. Then they will rely much more sometimes on the technology they use for lending. Like, for example, the joint liability contracts, which actually help them, to screen, to monitor, and also sometimes to enforce loans, actually. But there is some evidence over recent recent decade, actually, recently over the last years, that MFIs, especially from the commercializations, are shifting away from this joint liability model to individual lending model. And then they are becoming exposed to the same type of risk in the lending like banks actually. And that will affect also the direct lending by microfinance institutions. Okay. Well, there is also this channel of the commercialization of the funding channel. Basically, the commercialization channel is the idea that with the trend of the commercialization, the microfinance are moving away from its what we call the double bottom, actually mission actually, which is basically the mission drift. We observe that is actually the microfinance institutions are getting more and more to welfare customers, and especially through the upscaling strategy. And also, they are shifting away from the joint liability contract to individual loan contracts, actually. Then they are moving away from the traditional way of doing things, actually, which is basically the social missions, the joint liability contract type, and so on, to really the same type of behavior we are seeing from the banking sector, actually. And also, there is a literature actually by Brie and Zafar and Galima and also some of co-authors, which are, for example, Robert Lenzing and co-authors. They found that basically the microfinance sector actually is highly correlated with financial sector these days actually. The fact that we believe that is not highly correlated with financial sector doesn't seem to be really true. In general, actually, seems that microfinance institution is now becoming the integral part of the formal financial sector, actually. Then the type of behavior we observe in the financial sector in general, the same type of behavior will be observed in that, coming from the microfinance sector, actually. And then to continue on this funding channel, actually, well, because they are sometimes limited in terms of a domestic saving, they can really gather from really the domestic savers. Actually, sometimes MFIs will seek for external financing through the market funding, actually. Then they will go into the market, either to raise debt or to raise equity, actually, to be able to fund, the lending, actually. And that actually expose microfinance institutions, the lending, to really what is happening in the financial market, actually. Okay. Then if they fund directly, the activity through the financial market, that means that everything that will happen in the financial sector, in the financial market, will have an impact also on MFIs, lending, direct lending or indirect lending, some are actually. And we have seen, example of that, like if you take, for example, Equity Bank in Kenya, they have been, they use, the market to fund themselves. They have become a real, very big, institution these days. And we have also Compartamos, Banco in Mexico at some point of time and so on. Then we have examples of that, we have evidence of that, where some microfinance institutions actually finance themselves directly through the financial market, actually. Well, having said that, this is basically what we know from the literature. But if you look at all this, everything I present to you, basically, you see that we don't have really clear paper on really analyzing the direct impact of financial sector development on MFIs lending, actually, right? Really clear paper analyzing how really the development of financial sector will really affect in a country will affect really the lending microfinance institution will extend actually to small enterprises actually. And then this is what the gap we really want to fill actually, right? And then for many reasons, as I said, because small enterprises are very important in the economy, and also because microfinance institutions are providing some of the complementarity to banks actually into the economy actually. Then for all these reasons, we think that this topic is important to study and to look at it. And this is really where we are coming into it, I mean, in this literature actually. Then to do that, basically, based on the conceptual framework I show you, I mean, before, then the econometric model will be using basically will be on the one side, as explanatory, as a variable to be explained, it will be the loan ratio actually in the total loan of the microfinance institutions, the loan expended to SMEs. Then we look at the ratio of the loan expended to SMEs. Then we look at how much loans actually the microfinance institution spend to small enterprises. That's really our left-hand side variable, actually the explanatory variable. And then the dependent variable. And then on the right side, then we have, I mean, the variable like the financial sector development. And then I will show you the different variable we are using to capture financial sector development, because we do know that from the literature, there are many processes to capture financial sector development actually. Then we use many of them actually. And then depending on the variable you use, sometimes the result can be different actually. And then as additional, I mean, variable for control, actually, we also look at really the specific characteristic of MFIs, because as I said, MFIs do not have the same type of characteristics. I mean, they are not the same type, and also they don't behave the same way. Actually, then it's very important actually to capture some of the specific characteristics of MFI that actually affect the lending actually. And also, we also control for the macro environment and also for the business environment actually with the variables of a set of variables Y actually. Then we put all this together and then we run our regression to see basically if we can find any type of relationship between financial sector development and really lending, the MFI lending to SMEs actually. Well, then before running that, then the data will be using, basically, we use data from many sources actually, right? The MFI data is coming from the mixed market database, which is growing. I mean, there are many papers which have been using, I mean, this data ourselves. I mean, we use it for a couple of papers, I mean, recently also, but there are many recent papers which have been using this data actually for the study actually. The advantage of this data is basically you can make comparison across, I mean, across countries actually. And then this database expand across the world actually, and that's really interesting. Then we can have a nice panel, not only, I mean, in terms of country, microfinance specific, and also year data. Then taking this database, we end up with almost 8,000 microfinance year observations worldwide over the last 2 decades, actually, from 2001 to 2019. And this is a really nice database, I mean, to work with for this type of topic we really want to look at actually. The financial sector development indicators for us will be mainly from the International Monetary Funds, and then we'll be using 3 of the indicators actually developed by the IMF. I will show you those indicators soon. And then for the macro data come from, I mean, mainly the World Development Indicator database and also the Global Financial Development databases, all this from the World Bank actually. Then we combine all these databases to build our data actually to be able to do our analysis actually. Well, then these are some of the variables actually. Okay, yeah. Then, so I won't go through them, but basically some of the variables are we have a loan to explain to SMEs, the loan officers, the size of the MFIs, the regulatory, I mean, status of the MFI, the profit orientation of the MFI, the ownership status. Is it a private owned? Is it an NGO? Is it a cooperatives? And all this, we capture that. And also the lending methodology, in terms of really either they are using, individual lending or joint liability lending, and so on. And in terms of the financial sector development variables, basically, we will be using, three variables coming from the International Monetary Funds, and also we'll be using also two variables coming from, three variables coming from the, all the variables usually, used, by in the literature actually. One of the variable is the credit spending, to expend to the private sector by banks to GDP. This variable is usually used because it's readily available and so on and so on. There is also the liquid liability. Actually, the ratio of liquid liability to GDP also is a variable widely used also. And also the bank asset measured by the total bank asset divided by total bank's asset plus the total, central bank asset actually. These are the variables widely used actually. Then not only we will be using these three variables of the IMF, I will come back to them, but we are also using, these other, well-known variables people usually use when they try to capture really overall financial sector development within the country actually. But the three variable of the International Monetary Fund we are using, one is the Financial Development Index. This variable is interesting because basically it measures access, depth, and so on. So all these dimensions actually of financial sector development are measured by this variable because they pull all this together by using, principal component analysis and so on, building this index actually. Then it encompasses all the other dimensions actually of financial sector development. Besides that, we also use a variable which actually captures the financial market depth actually. And then we also use the financial institution depth because we believe that basically that if you come back to really my chart actually in terms of a conceptual framework, as I said, the MFIs will expand more lending to SMEs because they can get either the funding from the financial institutions, the banks, or they can get funding from the financial market actually. But that will be possible if we have a lot of depth in terms of financial market or depth in terms of financial institutions. That's why we are using these two variables actually to capture those dimensions actually. And then we have a financial development index as well actually. Then these are the variables we'll be using, and then we have a macro variables actually also we are using actually. Then with those variables, okay, then when we run our regressions, okay, basically, then what we found, I will only focus on the variables of interest. The other variables, are there. Actually, we can still discuss them. But you'll see, whenever we use the financial sector development variables in our regressions, they are all significant everywhere in our regressions. This is the total sample. Then when we use the total sample, and then we regress them using the financial sector development as an independent variable to explain, actually those lending, then we see that the financial sector development has a significant positive impact everywhere on this lending to SMEs actually. That's really the first result I thought about. Basically, we have a strong relationship between financial sector development and lending to SMEs actually. Well, basically, that's interesting, but I already said that basically MFIs are not the same. They are very heterogeneous in terms of the type of MFIs. Then we actually went further to say, okay, probably this involves a whole sample, but what will happen if we decided actually to group MFIs in terms of the different types actually? That's what we'll be doing actually. Then we look at really the profit orientation of MFIs. Could you have a question? Victor, I don't know if I can take questions now or because I can see your hand is raised.
Yeah. No, I'm happy either way. I don't know the rule. Is it the rule that you ask questions at the end? Is that the rule?
Be just so wait to the end because then we can have a fuller discussion and other people weighing in. If you don't mind,
that's fine.
Yeah,
no, I don't mind at all. Thank you.
Okay, thank you. Okay,
I'll put down my name, sort of.
Yeah.
How to do that? I'll do that. You carry on. I'll try to
Okay.
pull down my.
Yeah, don't
Not-
forget your question. Just keep your question up for you.
Yeah, okay.
Yeah, okay, thank you very much. Then probably we decide to look at really the different types or different, profile of MFIs actually. Then we did a grouping in terms of non-profit orientation and profit orientation of MFIs to see, do we see different type of really in terms of average of loans given to MSME? Do we see different really differences among those two groups actually? Then basically, if we look at in terms of profit orientation, we don't see any differences. I mean, when we do the different tests here. We go further and then we look at in terms of regulation status. For non-regulated versus regulated one, then we see really clearly a very different type of behavior, whether they are regulated or not regulated actually. And then we go further also in terms of type of ownership type actually. Credit union, privately owned, or NGOs actually. And then you see when we do that 2 by 2, we can see clearly that there are differences among those types of ownership groups actually. That's really interesting. Then we say, okay, maybe the behavior we have seen in terms of really financial sector development and lending to SMEs, well, those behavior, if we conduct the multivariate analysis, I mean, in terms of subgroup, maybe we will see really completely different type of pictures, actually. That's what we will be carrying out, I mean, next, actually. Then we did that. Then we use, I mean, the sample for regulated MFIs and non-regulated MFIs. And this result is very, very interesting, actually. Because basically, if you look at for the regulated one, what is happening is that the banking sector development, the financial sector development in general, and also the financial market depth, all this seems to be things that actually improve lending to SMEs, actually, for regulated MFIs. But for the non-regulated MFI, then you can see that banking sector development or financial market developments are not significant here, but the overall financial development is significant. That's really interesting because the overall financial development capture really efficiency, access, depth, and all these dimensions actually of financial development, which actually seem to be really positive for non-regulated one, but not specifically actually the banking sector expansions and so on. Because don't forget, the non-regulated MFIs are mainly, I mean, NGOs and so on. Not only NGOs, but NGOs are big part of it. And usually those institutions that don't really count on really financial market, I mean, funding actually to fund, I mean, to fund the lending. And then we did also in terms of the ownership status actually. Then in terms of ownership status, you see the same type of result I just found for the regulated one is almost confirmed for the privately owned one, which are, because the regulated one are mainly privately owned, I mean MFIs. For the credit union and cooperatives, looks like the funding from the banking sector has a big impact on them, and actually the financial sector development in general, actually for the NGOs, exactly as of the non-regulated one, you see I still have a non-significance between banking sector expansion doesn't have an impact, financial market, I mean depth doesn't have an impact, only the financial development in general actually, which is okay, actually normal actually, which has a positive impact on NGOs actually here. Well, basically, this is where we are now, because I mean, I have other results I can show you, but those one will be much more ways or controversy than really, I mean, help really in terms of explaining what we are doing, because basically we say, okay, let's now explore those channels much more deeply actually, right? And then we goes in terms of exploring those channels, but this is really, these are very, very preliminary, because I mean, we are still discussing, I mean, because we are still discussing on the way to go about them, I mean, actually in terms of econometrics actually, and it's because, I mean, we didn't really agree on really the clear way to go about it, then probably I will skip those ones. But basically, just to tell you that the channels we are exploring are basically, we will take now the liability side of the MFI balance sheet and say, okay, from our hypothesis is basically that MFIs will expand more lending to SMEs when the financial sector is getting developed, because it can come from funding from either the financial institutions or from the financial market. And then if we are getting more funding from the financial institution or from the financial market, then in the balance sheet, the liability part, we should be able to capture those channels actually, either from deposit to loan, or from borrowing to asset, or from debt to equity actually. Then these are the channels we'll be exploring actually in the MFI's balance sheet actually. But as I said, these results are not, these results are just very preliminary and so on. We are still exploring them. Then I will skip them actually. Then to conclude, on what I've presented here, just to summarize, basically what we have done, we have really investigated the relationship between countries' financial sector development and loan extend to SMEs by microfinance institutions which are located in those countries. And then we use, a worldwide, data on microfinance institutions over 20 years almost to analyze that. And then we found that basically a strong positive relationship between financial sector development and MFIs lending to MSMEs, actually. And in other words, improvement in the overall financial development index, defined as the combination of depth, access, efficiency, enhances MFIs lending to SMEs. And moreover, when we look at the banking sector asset expansions, really expansion as an indication of banking sector development, we find a very positive, significant impact of the expansion of this expansion and on privately owned MFIs, cooperative and credit union MFIs, and regulated MFIs lending, to SMEs. Yeah. But it's not true for NGOs and it's not true for non-regulated MFIs actually. Basically, Victor, as I said, this is it where we are actually on this paper actually. But as I said, this is really new result. I've just presented to you, but we really need, your ideas, how you can guide us actually in the way forward actually for us to really improve in the paper. And thank you very much for listening actually.
Thank you very much, Issouf. Let me do a hand of applause for the interesting work and very clearly presented. There is quite a lot of ideas to talk about here. I think we should be able to go into the cut and thrust and share some of the views. You reviewed quite extensive literature on this, and also identified some of the controversies. Indeed, we know that there are strong, theoretical foundations for this work. And maybe we should also touch on some of those theoretical foundations. What is so special about financial sector development that is of great relevance to a micro, small, medium enterprise lending? In theory, is it because of the availability of information asymmetries? The opacity interacting these institutions with the possible borrowers. Is it high transaction costs that may be in existence, which financial sector development tries to smoothen or reduce? Is it market segmentation that persists in this? Or is it actually, are we looking for a financial sector development characterized by improvements in the financial infrastructure to the extent that MSMEs find it very easy to do their lending? So there are some of these issues. Indeed, as you can see, as you notice, during your time at FDB, and especially the EBRD lending to European countries, the lending by these institutions, the MSMEs, is not done directly. They use intermediaries, and these intermediaries, of course, absorb all the transaction costs and all that, have the information, and then the SMEs then extend the lending to small farms. So there is a kind of a, so let's debate some of these issues. But you've done quite a huge amount of work and a huge amount of data down into the many possible classifications of the nature of SMEs. But also there are some assumptions here on whether the link between in the question you set about financial sector development affecting MSMEs lending, maybe not necessarily linear. Maybe when financial infrastructure improves and financial sector development record goes up, then of course MSME lending maybe increases, maybe up to a certain point. Maybe we need to look at the cross section as well as the time series properties of the data. Anyway, let me open the floor for discussion and views. So I will start with the core who had his hand up later, earlier, and then I can also see some hands, and so it is the core, and after core, I'll invite Doug for the comments. Core, please go ahead.
Right. Can you please upload your table of the results so that I can give you a couple of comments?
Okay, well, yeah.
That slide where you had your econometric results, the first
Yeah,
page.
sure. Yeah,
Thank
sure.
you.
Let me just go.
Okay, thank you. So now, yeah, please.
Yeah, you mean this table?
Yeah,
here, right?
this is the one.
Okay.
Now, a couple of things I want to clarify. This is, as you said, very much work in progress. Therefore, my comments would be for the potential improvement rather than criticism of your work. I'm nobody to criticize anybody's work, right? The world is big. People do all sorts of things. So let us be clear about that. Otherwise, people when you try to give some right comments which you think may probably help the researcher, you end up earning enemies. So I don't want to pass my comments if that is how things will be taken. Okay, right. Okay. Now, I have got specific and general comments, right? These days, I work little in this finance growth area. In the past, I used to do a lot of work in this area, and I must say that I'm a professor for the last 21 years, and first chair was bought by the research in this area anyway. So now, one thing we economists need to be serious and careful about how we do our research. Why I'm saying that? I'm not suggesting you are not serious, by the way. I'm including myself also here. If you ask me, this sort of approach and methods became extremely discredited during financial crisis of 2008, 7, 8. Until financial crisis of 2007 it happened. If you look at, leading to financial crisis, last 3 decades of research, where I also wrote several papers, okay, in time series and panel type of things, and everybody saying following the similar sort of this sort of approach. I'm not criticizing your approach. I have also done myself similar sort of paper. It's very ad hoc. It is very ad hoc, right? There is no sort of ends, beginning or ends, where one should start and where one should finish in terms of, and this is a reduced from econometric work, right? And therefore, when it is a reduced from econometric work and ad hoc, then which very right-hand side variable to include or exclude, there is no guidance at all. And unless that guidance is not there, results become completely sensitive the moment you change one variable. And that criticism applies on my own work. So I'm not criticizing your work. I'm talking about my experience. That is one thing which you have to be careful while sort of you are trying to develop this work. Clearly, there is a lot of work, as Victor said, has already you have put into it. I'm not suggesting this is obvious, but there are certain things. Now, this is general thing. So all of us who do this sort of aggregate sort of multi-country, cross-sectional and panel studies of finance and growth need to reflect very carefully. Subsequently, following the financial crisis of 2008, if you go and look at AER, JP in Journal of Financial Economics, etc., there are loads of paper, filled with, increasing in large financial system is very, hurting growth and all sorts of things. I don't want to go into that. Now, to comment specifically now on your side, first thing is that this is an empirical paper. What is your method of estimation? What is the econometric method we have used to get these numbers?
Yes. Okay. Yeah. Thank you very much. We are using, the fixed effect here. The fixed effect, panel fixed effect here. Yeah.
So if you are using panel fixed effect, then this estimation suffers from what we call reverse causality or simultaneity problem. Okay. You need to do something about it. You have got lag dependent variable, which means your first regressor, as I understand, is a lag dependent variable. So this is a dynamic specification in a panel framework, and you have got all sorts of right-hand side variables. You have to be careful about the issue of reverse causality or simultaneity in economics literature. Now, another thing I would like to say is that you have used 3 measures of financial development recently developed by in 2016-17 by IMF. Yeah, this is FD, FMD, and FID. FD is the overall index of financial development, right? And the measure is, this is a relative measure of financial development. This is not absolute measure of financial development, right? FMD is a financial market depth, and FID is institutional depth. These are relative measures. In other words, how deep is the financial sector of country A relative to country B? So these are relative, right? These are relative measures. But your dependent variable is not relative measure. So the implication here is, you may or may not appreciate, but implication here is that you may be estimating, this is just an example, whether in South Africa, okay, MSC lending ratio has gone up, your dependent variable, depending on so many things, including the relative development of financial sector between India and China. That makes sense? Probably not, right? So the FD, FMD, and FID, which you are using, the sample countries to derive that relative measure of overall financial development do not necessarily match with the sample countries which you are using to extract your data for SME lending. You may provide a footnote and safeguard your approach by saying that, okay, I believe the overall global relative financial development is closely correlated with the, or I assume that closely correlated with the financial development of my sample countries. You may get away with that, but you have to be aware with this issue. Okay. So there are lots of other colleagues who want to make these points, this sort of comment. I don't want to myself take all the time. There are lots of other issues you have to be careful in this paper when you take it forward. Thank you very much.
Yeah.
Thank you, Kur, for those observations. And yes, Kur has been working in this area for quite a while. Yes, and thanks for sharing some of those observations and learning for the benefit of this paper. Yeah, Issouf.
Yes. Okay. Thank you very much. Really, thank you very, very much. No, don't worry. I will not take anything personally. I even appreciate much more, right? Because I prefer to have more criticism here than having that. When I send the paper to a journal, right? And this is research. We are all aware of that. Really, this is really, truly, really appreciate actually. Just, I will want to just quickly on a couple of things. Your last point, I'm not sure I really understand very well, because the financial development we are looking at are country specific.
Look,
when we
I'll
talk about
financial
development, yes,
if you allow me, because I don't want to be the sole performer and question dominating the discussion here, I have to be careful. If you allow me 2 minutes, I'll explain. These relative measures are, okay, the IMF collects data for 100 plus countries, right? And assigns minimum development 0, maximum development 1 for every country. While developing these, okay, while developing these indices. I have looked at very closely these indices.
Okay, that's fine. No, that I
Okay.
got it. Okay, thank you.
Okay,
That's fine. Okay, yeah, I got your point actually. Okay, the point you're making. But this is also why. Okay, I know. I mean, indices. I mean, when we use indices to measure this one and so on, you see, always. I mean, the problem we have when we work on financial development. I mean, trying to capture it and so on. Actually, whenever way you go, there are always criticism on one way or on another way and so on. So, but this one is well taken, and this is why also we took other measures of financial development, which are not the indices of the IMF also actually to really, because these are the indices built by the IMF, but we took also other, I mean, financial development variable and so on. But I mean, the point is well taken actually. But in terms of reverse causality, we are aware of that. If you look at actually in terms of the explanatory variable, we include them with lag actually. I know, I mean, it doesn't rule out all the reverse causality problems, but at least you rule out it, I mean, a little bit and so on. But of course, these are the first regression actually. Then after that, we plan also to do, I mean, like robustness checks with other alternative econometric techniques actually, which actually we try to control for some of those reverse causality. I know we cannot rule them out completely, probably, but we try to, I mean, we plan to do that. But really, thank you, man. This is well taken. This is well taken actually, yeah. And I think Hubert also, I saw the end of Hubert raise, my co-author. I don't know if Hubert want to add something. Hubert, do you want to add something? Because
yes, Issouf.
Yes,
Thank you,
okay.
Jake. I just wanted to give couples of indications. One being that the result we are presented now is simply baseline result. As you said, Issouf, we are planning to extend analysis by doing couples of regression checks, including, let's say, JMM, to be able to assess, indigeneity and so on and so on. That's the next step, just after the first result we have just presented. That is what I was trying to add.
And
Thank
also, the last point, minor but important point, is make sure that whether your reported point estimates are elasticities or slope coefficients, what they are, whether variables are logged or not logged, whatever, it becomes difficult to interpret those things, right? Okay, thank you. I don't want to ask anymore.
Okay, thank you very much for your comment. Thank you very much. I mean, these are very appreciated.
Yeah. Thank you. Thank you very much, Cool. Much appreciated, and thanks, Issouf and Hubert for the response. Okay, we have another hand up, Doug.
Yeah, good afternoon, Victor. Thanks very much, and thanks again for organizing this wonderful event, and Issouf also for presenting it sort of on this great topic. And so of course it's important to make sure that you think about econometric methodology, the econometric techniques that are being used, and also the measurement of variables. Of course, that is important. But I'm also sort of interested in sort of the economic pathways, in particularly if you think about it from a policy perspective. And so your setup, I think I can buy into very much so. So you say SMEs, I mean, they may or MSMEs, they may not be very special for growth as such, but they may be in a particular segment. They may be more socially oriented and so on. But because they're not necessarily special, we don't necessarily have to give them special attention as such, or more attention than larger firms. But MSMEs face different constraints to their growth compared to larger firms. So large firms might be energy or whatever it is, and smaller firms it might be finance. And so we need to think about how to reach the MSMEs with finance. Now, then you could set this up and around sort of say, well, there's the financial market. As long as we develop financial markets, capital markets, and like, that's how you reach all firms, including MSMEs. Or you could say, no, that it won't work like that. The market on its own doesn't work. There are too many market failures there. You think about special funds, special microfinance institutions to reach them. And so there are these two different models. So there's an economic, there might be economic pathways in reaching them. Now you bring them together, of course. You then say actually MFIs, so these specialized ways of reaching them only work if there's a well capitalized market. But couldn't you also think about the other way around and to say, well, if the capital markets aren't developed well enough, you first start with some special funds, and as and when the capital market develops and becomes more complete, you don't need all the special funds anymore. And so then there would be a substitute. It would actually be not be a complement, as you would find, but it would be a substitute. So my question is a bit sort of from your economic pathways, from what you're understanding, is this what you found expected? Was it expected, or was it completely different from what you were expecting, taking into account all the economic pathways? And it's just to sort of, because that will tell us a lot about sort of the policy implications, right? So because are there special circumstances under which we just can rely on financial sector development, or specialized microfinance funds, or is it just the case that actually the answer to all of this is just financial sector development, because only then will microfinance institutions work? And we shouldn't think about microfinance institutions and supporting that. We should just be thinking, put all our eggs in the basket of financial sector development. So it's a policy question as well.
Yeah.
Assuming the answer that you got
correct
ones economically.
No. This is a really a good question actually, and it's a tricky question as you say. But I will try to respond to it. I think this is also linked to what when Victor was commenting. Actually, it's related to what Victor was saying actually, because basically we do know that why SMEs do not have access to financing. From economic theory, from a financial theory, because asymmetric information, usually the firm will ask for collateral and so on, so on, so on. All this, theory we know about, transaction costs and so on, so on. But if we think of financial sector development, you see, when I show you, this conceptual framework, actually, I said that when the financial market get developed, the financial institutions themselves, directly the bank and so on, they can directly lend to SMEs. Because with the development of the financial sector and so on, then we can think of all these regulatory rules and so on. All this makes somehow the transaction costs somehow much lower and so on. Then they can lend it directly. Or if we think of microfinance institutions as being important player because they are other type of expertise, then when the financial market get developed, the financial sector get developed, maybe for them, those institutions is much more better for them to go through actually the microfinance institution to be able to lend to those SMEs. Why is that? Because the microfinance institutions, they have the expertise to reach those poor people actually. Because of the techniques they use, actually they are much closer, the loan officer are much closer, the type of technique they use and so on. And also in terms of the transaction cost also, it's much more less costly for them to reach out those populations than the banks to do it by themselves. Then having the financial sector develop, maybe it can be much better actually for the financial sector to really go through the microfinance institutions to actually give them more leverage to be able to reach out actually those institutions, and then to overcome those asymmetric information problems and so on, so on. Because the microfinance institutions, there are more tools actually to much more overcome those constraints than the big banks actually for those populations actually. In terms of even the reduced transaction costs, collateral, requirement from the bank, but the microfinance institution, because the way they do it, either they use the joint liability, type of contract, or either they have real loan officers which are very close to the populations actually, then they can screen much better without even having strong collateral and so on, so on. Then all this I think this goes together somehow actually. This is a way I will see it at somehow. Then as the market gets developed, we get really more development in the market in terms of regulation, the environment, and so on, then it becomes much easier to really overcome most of these problems by going through the microfinance institution to be able to reach out to really more SMEs and so on, so on. This is, somehow I will see it, economically actually.
Yeah, and thanks very much, Dak, for provocative thoughts, provoking my mind, and the response from Issouf. In a way, the conceptual framework that Issouf presented, where you had MSMEs being funded by banks directly, and SMEs being funded through by the microfinance institutions, may help the policymaker in terms of if the objective function is what should we do to enhance MSMEs lending, which normally the policymakers are trying to do to promote financial inclusion, to enable also a bottom-up, approach that some countries are going for, and there I think would be an interesting way of finding out whether the MSMEs that borrow directly from commercial banks are the same SMEs that also get funding from microfinance institutions, or maybe it's a case that there is no double dipping because maybe the costs are different, maybe because some MSMEs have a better collateral or much more reputation. And in a way, one could even have do subsamples, we divided the groups of MSMEs into those getting funded by banks and those being funded by MSMEs, if there is no kind of interaction. But what it would do to the policymaker is to target the intervention. How to target the intervention? Well, how should we target the intervention? I think that the development banks like EBRD and FDB have possibly gone through the intermediate section by saying, okay, we need to find only those banks that are able to serve as intermediaries, and then we can do the intervention there. But I think the way this research is going, especially the conceptual framework, we could interrogate it a little bit further and generate something that would be a pointer for policymakers on where to target and why to target, because maybe those MSMEs that get funded, where banks fund the microfinance organization, microfinance then funded, maybe that's much more efficient. Maybe then it is much more efficient, or we don't know, but research can show. Yeah, I think I got somebody. There is a hand up. Sandrine. Yeah, Sandrine Cablan also works in these areas for many years. Good to see you, Sandrine.
Yes.
Go ahead.
Good morning, good afternoon, everybody. I just wanted to add to the discussion and say that the argument that Professor Soumaré has raised, according to which microfinance institutions are more able to answer the loan coming from small and medium enterprises is not so straightforward, because if you remember in the case of West African Economic and Monetary Union, when those microfinance institutions try to answer to lend to small and medium enterprises, this creates a huge crisis in the sector, because they didn't know very well the sector, because they were more I mean the expertise were more fitted to the micro enterprises. So yes, you are right in a sense, in the sense that because commercial banks are not able to answer the demand of loans coming from small and medium enterprises, microfinance institutions tend to fill this gap. But as Victor has just said, it is important for the regulator to better regulate and to better organize the market, so that maybe microfinance institution will be better able to answer loan coming from small and medium enterprises. This is what I wanted to say. Thank you.
Yeah, thank you very much, Sandrine, I mean, for bringing this out. I think, I mean, in your intervention, there are two things actually, basically. There are the risk dimension actually, which we are not looking at actually, because one thing is basically when they are spending those loans to the SMEs, what are the risk dimension underneath it? But we are not looking at that one. That can be really interesting also to look at that dimension. But the other part is basically if we think of, because basically when we talk about financial sector development, actually, but financial sector development encompasses also the regulatory aspect also, right? I mean, because when we talk about the overall financial sector development, it means that you have better regulation in place and so on, so on. All this, I mean, should be really, even, I mean, the regulation in place, I mean, to regulate, I mean, those institutions also is sound and so on. Then all this, I mean, should be included. It's not like they are separated completely actually, right? I mean, like, it's not like we have financial sector development and we have regulation on the other side actually, but this is well taken actually, right? Of course, the risk dimension. Then another question is basically when they do it, does that increase? Is this financial instability or not? Actually, that should be probably the next question actually to this underneath this one actually, because they can expand loans, but probably the risk can increase at the same time also. But we are not looking at the risk dimension at this time. But that's well taken. Yeah.
Thank you very much, Sandrine and Issouf for the response. Just maybe it's not fair for me to ask this question because is there any cost variable in this? Well knowing that cost considerations, especially high cost problems, that's the divides the wage, between MFIs, banks, and MFIs. I don't know. Maybe you already have it, in which case you can ignore my point. The cost consideration, which would, given that maybe it's the differences, could be transaction cost or could be any cost, even the cost of funds.
Yes. I mean, Victor, I think, I mean, this is a very good point, actually. I think probably, I mean, we don't have a cost dimension, but this is well taken. Probably this is something we should bring it, because, I mean, yeah, especially probably we can look at maybe the interest rate in deposit, interest rate on lending also. These are something, I mean, we can bring into it actually. Yeah, that will be interesting actually to capture those cost dimension actually. Yeah.
Thank you very much. So we also got a hand up. Yes, Hubert.
Yes, I just wanted to add something, Victor. Yes, regarding possibly cost. Now, up to now, we found that there is possibly direct relationship between financial sector development and loan to micro, small, and medium-sized enterprises. That is what we found now. But as for cost, possible channel be to assess whether the MFIs is subsidized or not. And capturing subsidization may be through the difference between the loan price, let's say the borrowing cost, interest rate by the banking sector in a country. We can proxy subsidization by computing the differences between the price of loan, the price of loan in the market, and the price that on which an MFIs buy money. You may include that to capture the possibility that being subsidized drives the effect of financial sector development on small and medium-sized enterprises loan. I think that you have data to compute that.
Absolutely, that would be very interesting. Yeah, thank you very much. Yeah. Okay. I see more hands up. Yi Bai, and then Simpasa. Anthony.
Thank you, Victor, and thank you, Issouf. That's a very interesting presentation. Really enjoyed it. I got a few questions. It may not be fair because your data is at the moment aggregated data, but I will just probably ask anyway. So you can tell me it's not available, the data, so you can't do it. One thing I'm thinking of is when the student I have, she's working on the Chinese MSME. We realized that the definition of MSME is very different in China to what you see in the literature, and that definition is government state. So because you look at cross country as well, I wonder if you have information on that. Because if the size is very different, cross-country, how MSME defined, that would ultimately affect the risk faced by the microfinance and the banking sector overall. That's one thing. Another thing is also yes, it's also something to do with being aggregated. If we could, I don't know if possible, look at the micro and small separately from the say medium, because the let's say some of the medium enterprise, they could get listed in China in a very recent time. Then in that way, the development of equity market, that would be part of the financial development, right? In a way, that's not complementary. They are actually substituting the access to finance to those medium-sized enterprise there. But I don't know if it's possible for you to separate them. And then another thing also to do with the MSME side is in terms of industry, which industries we are looking at, because some of them may have preferential treatment by the government. Then the government may encourage the let's say state-owned bank financing specific industries. And some countries, maybe it's through microfinance institution. So I think if you think about channel, there are a lot of varieties, but that involves looking into subsample. But I'm not sure if the data is that rich. So yeah, that's my comments. Thank you.
Thank you. Yeah, I appreciate it. Yeah.
Thank you very much, Yi, for those comments. And so I think, these are very helpful, actually. And then basically, you are really, we will be really going back, really to check again the data. Because, for MSMEs, well, go to check the data. I have to check with, actually, the young guy among us, because, that's the nice thing about when you are full professor. You don't go too much on the data anymore, right? Then I can ask Désiré to check. But we check really the MSMEs definition in the mixed data, the way they do it, because basically we took the data from the microfinance institutions. Then I don't know if the definition is by country, actually, to look at really in the balance sheet of the MFIs, if they are taking into account the country to really define the number of loans going to MSMEs. That one I don't know. I have to check with him. But if they are doing it by country, then that's kind of help a lot. But I have to check that one. And that's a really good point, actually. But in terms of a division, in terms of micro and small and medium-sized enterprises, I don't know that we I know that because we did it even before. We had small, medium-sized enterprise. We had the small SMEs actually and micro actually, and after that we decided to put them together. But now again, I will put Désiré to check. I think probably we can have medium one, but that one I'm not sure. But I do know that micro separate from the others, we had it. We can have that separation actually. But if we can have also medium, that would be interesting actually to see if we can see the different type of behavior depending on the type of lending on the business segment. That will be really interesting, of course. In terms of the industry of SMEs, that one I'm not sure. That one I'm not sure because what we are basically, these are on the balance sheet of the MFIs. These are how much lending they do to SMEs, for example. But in terms of industry, that one, I'm not sure if we can get or this disaggregate type of level data with the sample we have actually, right? Exactly.
Yes,
yeah. Okay.
I agree. That could be difficult.
Exactly right. Yeah. But thank you very much.
Yes, maybe
Yeah.
let me maybe
Yeah,
add some,
go ahead,
yeah, two or three things. To date, it will be difficult for us to specify the industry in which belongs small and medium-sized enterprises we have. Given that we have data on balance sheet, we don't have loan level data. If we would have had loan level data, that could have been possible to characterize SMEs by industry. We don't have the data. We don't have that information in the database up to now. And yes, so we can easily disentangling micro enterprises and small and medium-sized enterprises in the data. And I think that doing that could relate the point raised by our colleague to the point raised earlier by Sandrine, given that maybe each microfinance institutions, they are very close, let's say, to small enterprises, but less close to small and medium-sized enterprises. Business model is different depending on the type of enterprise they are targeting.
Yeah, thanks very much for that. I think, yeah, that's I think great. That makes a great sense indeed. There is also a in the chat posted by Viceroy about the heterogeneity of the MFIs. Maybe I could invite you, Viceroy, to make the comment. Let me see.
Yeah, probably don't think I'm seeing those comments. I'm in the chat.
Yeah, thanks. Please go ahead. Oh, apologies, Anthony. I'm gonna come back to you. Yeah. Oh.
We are not hearing you very well. Yeah, it's like
your voice comes out differently.
Probably check on your side.
I think it's possibly the communication that he's using. So maybe I should read the question because maybe you don't see it, Issouf.
Yeah, I don't see it.
Vaseloye is saying, given that MFIs in the sample are largely heterogeneous, they're heterogeneous in terms of deposit taking, regulation, and so forth, how much of the contribution to financial sector development can we attribute to an MFI factor, i.e. microfinancing institutions' own model, versus a bank factor, given that some may behave as a banks undercover or some sort of banks? Yeah.
Yeah, that's okay, right. That's come back to, we point, like Kul made before, right? About all this or reverse causality things and so on, right? Because we believe that actually the microfinance.
Sorry, Victor. Is it better now?
Yeah, it's good now. So go ahead. Yeah.
Yeah, okay. So apologies for that. The camera sometimes is not behaving. So thank you, Issouf, for the presentation. It was very interesting. Really enjoyed it. My question was from one of their slides. I think it was slide 9 that you were talking about the heterogeneity within the microfinance institutions. And actually, I mean, to me, it would be nice if there is like a definition of what is a microfinancing institution and how is that different from a bank.
Okay.
Because in that slide, you were talking that because of the heterogeneity, some MFIs might be taking deposits, there might be issues with the regulation, so some may be regulated, others may not be regulated. So my question was about how much of these contribution to financial sector development is really from a microfinancing factor, if we can call it like that, and how much is it because a microfinancing institution is really a bank? Because if it's taking deposits and is regulated, then how is that different from a bank? So are we saying that, you know, banking generally increases financial sector development, or is it that some microfinancing institutions are doing something differently, perhaps in their business model or perhaps in how people perceive it, you know, that leads to the development?
Yeah, this is a very important question also because some FMIs have actually grown to become big banks. Have become to say in Africa, some of the initial microfinance firms have grown to become Pan-African banks. So in terms of transition over time, so maybe one really has to make a caveat or an explanation of the distinction. But Issouf.
Yeah. Okay. No. Thank you very much. I mean, in terms of really the different types of MFI, in terms of heterogeneity, of course, I mean, in the paper we will really define them. I mean, because there are clear definition of them actually. Then, like, you can go in terms of regulatory status. I mean, like, in terms of regulation, to see that in some countries really their MFIs are regulated clearly, and other countries they are not regulated. And usually, the distinction is made clearly actually. And then also in terms of really the type of MFIs, some MFIs are, we say, are privately owned. It means that you have owners who are, they are private ownership, and then some of them are like credit union and cooperative and credit union. These are type of MFI also, and some of them are NGOs, non-governmental organization actually, right? Then not profit oriented and so on. And these definitions are clear and well known actually. And of course, among the privately owned also profit-oriented MFI, there are some of the MFI which are much more closer, like we'll call them, I mean, bank-like MFIs. They are very close to banks, but they are not banks. And also those ones also the definition are clear, because if you take any country actually, to become a bank, usually, I mean, when you register as a bank, in terms of requirement, the capital requirement and so on, these are known. Usually, the capital requirements are very high, and also even the banking regulations sometimes are different from the microfinance regulation and so on, in terms of risk management, the Basel and so on. And then if you register as a MFI, even if your behavior is almost like a bank, but no, you are not a bank because your capital level is not like the capital level of a bank. In some countries also, the regulations applied to you will not even be like a bank. But in some countries, like those type of MFIs are almost regulated like banks and so on. But those definitions, we can make them clear really in the papers actually, really to be clear about it actually. But in terms of, I mean, really, and then this is why actually we want to explore this of it, like depending on the type, we want to explore it. Because we do believe that in terms of behavior, NGOs and the privately owned will not have the same type of behavior. Because if you take NGOs in general, actually, usually they don't take deposit actually. These are subsidies and so on. Then they just take the money and then they are there for subsidies. And even the type of loan they give actually, because they are not seeking profit actually, then the behavior is completely different from those bank-like MFIs or those credit-oriented MFIs, which behavior are completely different because they are there to seek profit. And then for those MFIs, how can they balance between like the social missions they have to achieve to be able to reach the poor and at the same time be able actually to make profit actually. Then you see, I mean, that's the behavior are completely different depending on the type of MFI and so on. And then this one, we want to explore that. For the first result we are seeing, you see the preliminary result, we are seeing the different type of behavior actually. In terms of if you are like privately owned, or if you are NGOs and so on, we are seeing kind of different things. But the other part of your question, which is basically, it's come back to this reverse causality, I mean, like we had, I mean, before as comments. Well, if you look at in many of these countries, actually, many emerging countries and so on, if you take, for example, the size of the microfinance, I mean, sector, in the total financial sector, usually is very, very small, actually, right? I mean, so if you measure the financial development as, for example, the size of the assets of those financial institutions is very, very small. Like Sandra was talking about the YME region, but if you take it, usually the banking sector will be maybe 95%, for example, of the total size of it and so on. Then I'm not sure that will create too much really reverse causality in terms of, in that sense, really, I'm not sure of that really given the size. But of course, the number of people, of course, they are able to reach is another story actually. Then in terms of size, in terms of type of assets, maybe not, but in terms of really the number of people they are able to reach, usually, then they will be able to reach more people really. Then if you measure it by number of people, that will be another story actually.
Thanks,
Thank you.
Issouf.
Thank you.
Yeah, thank you indeed. Just in the interest of time, and I think let me call that two hands up. One, Anthony, and sorry, Anthony, I skipped you earlier. So, and after Anthony, Abby. Anthony, please go ahead. Are you still with us, Anthony Musonda from FDB? Yeah. Anthony Simpson.
Looks like he's muted.
You are muted, actually. Yeah. Are you still with us?
Can you hear me now?
Yes.
Yes.
Can you hear me now?
Yes, we can hear you.
Okay, thank you.
Thank you.
Yes, I was saying that congratulations to Issouf and his co-authors for this very interesting paper, which I found very, very enjoyable myself. I have a couple of questions, some of which arise from what he has just been saying, that the paper does provide a very strong motivation on the heterogeneity of the MFIs across the sample size that they've looked at, being an international sample, especially on the issues of regulatory regime and other considerations. My question is whether some of these sources of heterogeneity are reflected in the results that we are seeing. And please pardon me, I've had a very choppy connection, so I might have missed some of the results that may be addressing some of these issues. For instance, I would want to believe that the regulatory environment in some of the low-income countries may be slightly different from those obtaining in advanced economies. And therefore, the effect on how microfinance institutions operate vis-a-vis the lending to micro, medium, and small enterprises will be equally different. How do we capture these sources of heterogeneity so that the results that we receive reflect what is motivated in the paper? That's number one. Number two, and it was, I think it's Hubert who talked about this, the subsidization. Because the sample comprises, again, profit making, who may also be deposit taking MFIs, and those that are sponsored by development financial institutions and other NGOs that may have a more social leaning than the profit leaning MFIs. So how do we disentangle the differences by those that receive deposits and those that are subsidized either through grants that then they own lend to small and medium enterprises? Because those that receive deposits may have a separate cost consideration than those that are purely grant recipients. So I just wanted to know what caveats, if any, have been provided in the paper to take care of some of these potential sources of disconnections. Thank you very much.
Thank you.
Thank you very much, and thank you very much, Anthony, for these comments. I mean, which are more related to what Vasily also said actually. But the heterogeneous, because you see, in this MFIs, literature actually, the grouping, the way we do the grouping is known actually, right? Either we do grouping in terms of profit oriented, non-profit oriented, deposit taking, non-deposit taking, regulated, non-regulated, ownership type, you have a privately owned, credit union, credit union and cooperatives and NGOs and so on. Then the groupings are known actually. Then what we do basically when we do the global, actually we for all the sample, as we said, we control for MFI specific characteristic actually. Then in the MFI specific characteristic, some of those characteristics are captured there actually, to be able to control for them some of those specificities actually. That's in the global with the full sample actually. But now, because we know that there are heterogeneity among MFIs, that's why we do actually the subsample analysis actually, right? Then we subsample by either they are profit-oriented or not profit-oriented. That's enough one sampling. Either they are actually deposit taking, not deposit taking. That's enough sub-sampling. Either they are regulating or they are not regulating. This is another sub-sampling. Or by ownership type, where we look at a really risk-free ownership type, privately owned, credit union and cooperatives, and also NGOs and so on. Because we do know that, as you said, actually, the behaviors are completely different sometimes actually. And then we don't have the same type of behavior. And also in terms of the channel to analyze. That's why in terms of the channels, we are analyzing many of the channels in terms of the balance sheets. Okay, as Hubert said, we will be analyzing the channels of the subsidizing, for example. Because we know that subsidies in terms of channels will not have the same impact for NGOs than like for banks like MFIs, for example. Because for NGOs, subsidy is a big part of really the liability actually. And then also we'll also analyze the borrowing actually. If they are borrowing from the capital market. But of course, when we are talking about borrowing, probably that will not apply to NGOs at all, actually. Then that's why we want to explore really many channels, actually, to be able really to draw really a very nice story, to be able to explain why what we are really observing, for example, for privately owned, why is it that? And what we are observing for NGOs, why are we observing this type of really result for NGOs and so on? That's when we will do really the channels analysis actually, which is the next step actually, we'll be able to do that. But for the heterogeneity, I'm not too much worried about it because not only in the full regression we control for those heterogeneity because we have MFI specific characteristic capture there, but also we do really subsample analysis actually to be able to explore deeply those heterogeneity effect, by subsampling actually. Yeah.
Thank you very much, Anthony, and thank you very much, Issouf, for our response. I think we are running out of time, but we'll accommodate the comment by Abi. Abi.
Okay. Hello, everyone.
Please go ahead.
Very good. Thank you, Issouf. I think I would focus on the economic structure points that I have, because you control for the informal economy using the mimic indicator. So when you look at the econometric result, it shows there is a negative relationship. I think this might relate to what Yi mentioned with respect to distinguishing between micro and small and medium enterprises. Therefore, I was agonizing over how I can interpret that. That is one. The second one is you have also another way of estimating informality using the DGE approach. I think there is a lot to uncover there. That is one. Two, the business environment, you said you control for a business environment, but I don't see any business environment regressor in your model. And finally, I think the econometrics, fair enough, it is preliminary, very interesting, encouraging results, but I don't think even going to GMM will solve your problem of endogeneity there. you should really go into the direction of disaggregating and finding country-specific coefficients using ARDL option, maybe. So these are the 3 quick points that I have. Otherwise, very promising.
Oh, thank you. Very high quality. Thanks, Abi.
Yeah, Abi, thank you very much for these suggestions. Actually, of course, when I was doing the interpretation, I put much more emphasis on interpreting the result of the key variable we want to look at it. Actually, for the other macroeconomic variable, we have other macroeconomic variable. I didn't really spend too much time on them, like the GDP growth, the unemployment rate, and informality, and so on, so on. Of course, I agree with you that these are things we should be exploring and to see really the science and also how to make interpretation of them if they can bring something to interpretation. So thank you very much for bringing that. And for the econometrics, actually, I think I will get back to you right after this meeting. Also, I think I will connect with you. On some of this actually, right? Yeah. So to my this, but I think that's for just for suggestion. But I will connect with you after that. Yeah. Thank you very much.
Yeah, thank you so much. I think that's a very good point to end the discussion. Of course, discussions will continue but please join me in thanking Issouf, Hubert, and Désiré for starting on this very exciting work. And this exciting work already has very, very important messages and work done. And I think I also want to thank you all for the contribution to the discussions, which I think Issouf and his team will then be thinking of how to explore all these. As always, in every research seminar, there is no comment that doesn't add value. Even a footnote will matter to some of the referees that sometimes tend to give us all the desk rejection because of a simple matter. But I think in such a seminar, we're able to interrogate some of those issues, to get some suggestions, and also think about the policy implications of the paper. So thank you, Issouf and team, and thank you all of you for being able to make this seminar.